Imagine a market in panic. Prices are falling sharply. Hedge funds are rushing for the exit. Wall Street analysts are lowering their price targets. It looks like a classic sell-off. Now, imagine at the exact same moment, one of the world's most powerful financial institutions is doing the opposite. It is buying. It is buying aggressively. It is buying more than it has in years. This is exactly the scene playing out in the gold market. In June of 2026, gold prices dropped by around 12%. The sentiment turned bearish, but the People's Bank of China, the central bank, did not follow the crowd. Instead, it went on massive buying spree. Reports indicate they purchased an extraordinary 480,000 ounces of gold. This raises a fascinating question. Are the Chinese central bankers simply bargain hunters? Or is something much bigger happening? Something that could reshape the financial system? Welcome to China and the World channel. I'm Man, your host. I bring you the latest fascinating facts about China. If you like what you're viewing, please smash the like button, share, comment, and subscribe to all. Today, we are not looking at rockets or robots. We are looking at a different kind of technology. The technology of finance, the technology of international settlements, and a quiet but powerful strategy that could challenge the dominance of the US dollar. In this video, we will decode the gold price drop, the Chinese central bank's counterintuitive buying, and the launch of a new settlement system in Hong Kong. We will explore the connection between physical gold, China's cross-border interbank payment system, and the global push for de-dollarization. By the end, you will understand that this is not just about gold. It is about the future of money itself. Let us start with the recent price action. Gold has been on a strong run. It reached highs of over $5,500 an ounce. Then a correction began. This is a significant drop for a safe haven asset like gold. What caused this? Several factors contributed. First, there was a strengthening of the US dollar. Gold is priced in dollars. When the dollar goes up, gold often goes down. This is a simple mathematical relationship, but it has a big impact. Second, there was a shift in market sentiment. Investors began to believe that interest rates would stay higher for longer. Gold does not yield interest. When rates are high, the opportunity cost of holding gold increases. Investors can earn a return by holding bonds instead. Third, there was a technical selling. Large hedge funds use algorithms to trade. When prices fall below certain key levels, these algorithms automatically trigger more selling. This can create a downward spiral. The panic was real. Wall Street analysts cut their price forecast. Gold exchange traded funds saw heavy outflows. The short-term traders and speculators were fleeing. The mood was bearish. But in finance, as in life, the crowd is often wrong, especially when it comes to long-term strategic moves. This is where the Chinese central bank's action becomes so interesting. They were not panicking. They were accumulating. While Wall Street was selling, the People's Bank of China was buying, and not just a little. They were sweeping up gold at an accelerated pace. It is estimated they added around 480,000 ounces to their reserves in a single month. This is not a new trend. China has been buying gold for 20 consecutive months now. This is a sustained strategic campaign. It is not a one-time trade. It is a long-term accumulation. What are the numbers? Chinese official gold reserves are now over 2,200 metric tons. This makes it one of the largest official holders in the world. But it is important to understand that China has a large economy. As a percentage of total foreign exchange reserves, gold is still relatively small. It is around 5%. This is where it gets interesting. In most Western countries, gold represents a much larger percentage of reserves. For the United States, it is over 70%. For Germany, it is also high. China has a lot of room to grow if it wants to. So why are they doing this? One reason is simple diversification. China holds trillions of dollars of US Treasury bonds and other dollar-denominated assets. This is a risk. If the value of dollar falls, or if the US defaults on its debt, China would suffer huge losses. Gold is an asset that is not tied to any one country's currency or policies. It is a hedge against the dollar. Another reason is the decoupling from the US financial system. There is a growing trade and political tension between the two countries. China wants to reduce its vulnerability to US sanctions. In a crisis, the US could freeze or seize dollar-denominated assets. This is a real concern. Gold is physical. It can be moved and held outside the US system. A third reason is about preparing for a new monetary system. This is the most strategic reason. China is not just buying gold to protect its wealth. It is buying gold to build a new financial infrastructure. This brings us to the next part of the story. Now, we come to a crucial piece of the puzzle. On July 7th, a new system was launched in Hong Kong. It is a central clearing and settlement system for gold. This is not just a routine upgrade. This is a significant development with far-reaching implications. To understand why, we need to think about how gold is traded globally. The two main centers are London and New York. Gold is traded over the counter in London and on futures exchanges in New York. The settlement of these trades is often done in US dollars. The price of gold is set in US dollars. This system gives a lot of power to Western financial institutions. They control the price discovery and the settlement mechanism. Now, imagine a new system in Hong Kong, a system that allows gold to be traded and settled in Chinese yuan, a system that is linked to Shanghai and other Asian markets, a system that is outside the US dollar ecosystems. This is what the Hong Kong system could achieve. Let's break down why this is so significant. First, it provides a path for price discovery in Asia. For the first time, there is a major hub where gold can be priced during Asian trading hours. This can create a more balanced global market. Second, it facilitates physical delivery. In Western markets, most gold trades are settled in cash. The new system in Hong Kong is focused on physical delivery. This is important for central banks and other large holders who actually want the metal. Third, and most importantly, it bypasses the US dollar. If trades are settled in Chinese yuan, then China can buy gold without needing dollars. This is the real game changer. It means China can use its huge gold reserves to support the Chinese yuan without needing to use the dollar as an intermediary. It is a system operating outside the mainstream dollar-based settlement networks. It is a parallel financial infrastructure. This brings us to the big picture, the concept of de-dollarization. This is a process by which countries reduce their reliance on the US dollar for trade and reserve holdings. For decades, the dollar has been the world's reserve currency. Most international trade is invoiced in dollars. Most central banks hold the majority of their reserves in dollars. And most international payments are cleared through the SWIFT system, which is based in the US and Europe. This gives the US enormous power. It can use the dollar as a weapon. It can impose sanctions that can cripple the economy of another country. China is building alternatives. It has created the CIPS, the cross-border interbank payment system. This is a payment system that allows international transfers in Chinese yuan. It is designed to be an alternative to SWIFT. Now, China is building a gold settlement system. This provides a tangible asset to back the Chinese yuan. If a country can buy and sell gold in Chinese yuan, then Chinese yuan becomes more useful. It becomes a currency that can settle trade in a valuable commodity. Consider the logic. If China buys gold, its Chinese yuan becomes more valuable. It is no longer just a claim on the Chinese economy. It is also a claim on gold. This can build trust in the currency. Furthermore, if a country has a large gold reserve, it can issue bonds backed by gold. It can provide loans denominated in gold. It can create a financial system based on physical assets, not just government promises. However, from the perspective of the US financial establishment, this is indeed a terrifying prospect. The dominance of the US dollar is the bedrock of American economic power. If that is challenged, the implications are enormous. So, what does all of this mean for you? For the average person who is concerned about their savings and investments? First, it means gold is not just a short-term trade. It is a long-term strategic asset. The volatility we see in the market is a product of speculators, but the underlying demand from central banks is structural. They are not trading for profit. They are building a financial foundation. Second, it suggests that the long-term trend for gold is likely upward. As central banks continue to buy, it reduces the available supply. The price is driven by scarcity. Third, it means you should be aware of the geopolitical risks. The financial system is changing. The rules are being rewritten. An investment strategy that worked for the past 40 years may not work for the next 40. Fourth, diversification is more important than ever. Do not put all your money in one currency or one asset. Consider holding a small percentage of your portfolio in gold. This can protect you against currency devaluation and financial instability. Fifth, be aware of narrative. Wall Street analysts have their own interests. They often promote short-term thinking. The Chinese central bank is playing a long game. Try to think like them. Think about the future of the global monetary system. This is not about predicting the next month or the next quarter. This is about positioning for the next decade. The world is changing. Gold is a hedge against that change. In conclusion, the story of the Chinese central bank buying gold while the market sells is a classic example of the difference between short-term trading and long-term strategy. Wall Street is selling because of quarterly performance and algorithmic trading. They see a falling price and they panic. China is buying because of a 20-year vision. They see a changing world order and they are preparing. They are building a new financial infrastructure based on physical gold. This is not just a trade, it is a foundation. The launch of a Hong Kong gold settlement system is a significant step in this process. It creates a parallel ecosystem that bypasses the US dollar. It allows the Chinese yuan to be backed by something tangible, gold. It provides a route for countries to trade without needing American approval. This is a real gold war. It is not a war of bullets and bombs. It is a war for control of the global financial system. The outcome will determine the balance of power for the 21st century. As a Chinese proverb says, a journey of 1,000 miles begins with a single step. The gold purchases in the new settlement system are those steps. They are creating a path to a future where the world is less dependent on one single currency. What do you think? Is the Chinese central bank smart to be buying gold? Is this the beginning of the end of the dollar's dominance? We would love to hear your thoughts in the comments. Thank you for watching this episode of the China and the World channel. If you found this analysis valuable, please like and subscribe. We will be back with more in-depth coverage of the technology and finance shaping our world. See you in the next video.